How am I going to make money this year? One of the ways is by not losing it. Let's talk about avoiding landmines on the weekly update. Okay, friends, let's talk about avoiding landmines. Here's what you need to know. First up, as our 2026 rebalancing approaches, I'm adopting a strategy of avoiding landmines for the year. And all we're trying to do here is just stay out of the way of some of these big forces that are having a negative impact on certain areas of the market. First, let's look at the market broadly. So here's the S&P 500, same way we've always looked at it. Red is the S&P, orange is the 50-day, purple is the 200-day, and what do you notice? Well, our uptrend continues, although the pace has slowed pretty considerably since Liberation Day. Here was the very sharp sort of, like the V bottom and then a very vertical ascent for the market. And then more recently, things have started to enter into a consolidation phase while still working its way higher, but just the pace has slowed. If you draw a line here, you can see that the slope of this line is much higher than the slope of this line. And I think that's perfectly fine. That's actually healthy. 50-day is still support. 50-day was support once, twice, 3 times in recent history. That's good. And what this consolidation is going to do is it's going to allow the 200-day to catch up here. And that's going to be good because this is much stronger support than the 50-day. So I like it. I get nervous when we get very far away from the 200-day because it means that the market needs to drop a whole bunch before we get any sort of signal as to whether things are good, bad, or indifferent. So the 200-day catching up here is very positive, very welcome. The uptrend is in place and looks healthy here. So let's talk about some of those landmines, and here's what I mean. So what is a landmine? A landmine, well, when you step on it, it blows up. And I've got 3 of them here that I just want to talk about as things that we are, as we go through our rebalancing, that's going to happen. Models should be done by the end of this month. Trading takes place in February and into March, One of the things that we're trying to do is avoid stepping on these landmines. So here's the first one. First one is politics. I've talked about the midterm process. I said, hey, I think it's going to cause some upheavals. And where we are seeing that first is in health insurance. Now, we're going to look at some of these stocks. We're going to look at United Health as kind of like the poster child for health insurance upset. But these stocks are still okay, right? Even if they're in a downtrend, even if they look bad, like United Health is, I think, the nation's largest health insurer. Health insurance isn't going anywhere. So these are really just sort of like tactical ideas for 2026 sort of thing. But our landmine is politics. And health insurance just recently hit an iceberg. There was widely expected to be an increase in Medicare, Medicaid reimbursements to these insurance companies, and that didn't happen. And I think this was very easy to predict. Trump has already come out saying he doesn't like the insurance companies. They're charging too much. They don't, give enough benefit. All of those populist messages that go into the midterms. And so I think this was one that was pretty easy to predict, and it's happening. So one of the landmines that we want to avoid, the message isn't avoid health insurance. The message is avoid the midterm landmine. And the nice thing about Trump is he tells you what he's going to do before he does it. So if he starts talking negatively about any segment of the market, if he were to come out and say, hey, these Mag 7 guys, I don't like what they're doing, you better be careful because it means that the hammer is coming. So we want to avoid the politics landmine for 2026. Second landmine we're going to talk about is software. And so what I'm showing you here on the page, this is the software ETF. And this landmine that we're talking about is disruption. And what is happening right now, there were these businesses called software as a service. These are businesses that you pay a recurring monthly fee to, and they provide you services, software that you can use on your computer. The best example is Microsoft Office 365. This PowerPoint slide deck that you are looking at on your screen comes through Microsoft PowerPoint. I pay $200 a year to maintain this license and use this software. And this was a great business. These were fantastic businesses. If you look at the last 10, 20 years, they have absolutely outperformed. VCs in Silicon Valley would tell you that, software is eating the world. And then something happened in October and November of last year, and software has lost its luster, and this trend is accelerating here in 2026. And what's happening is the disruption of AI. Technologic disruption is one of those things that you want to be careful of. There is something going on here in software that has never been seen before. And what I think is happening is AI is eroding the moats for all of these software businesses. So if this was 2025 and we were looking at the 20 years prior, we would say these are amazing businesses with big moats and they're going to continue to capture more wallet share and do more in the future. In 2026, if we look forward, what's coming out the windshield, it's telling us that, hey, this AI disruption might be real. And these businesses may not be as defended as they looked in the previous 2 decades. And there might be something going on here. I am not smart enough to know if AI is going to disrupt these guys or not. I'm not smart enough to know who is going to survive the wreckage. What I am smart enough to know, below the 50-day, below the 200-day, I'm smart enough to know we want to be reducing our exposures here. This is a downtrend, technically, if you look at the charts. So our second landmine, we're avoiding technological disruption. So anything that's going to get disrupted, we probably don't want to be there. Third one is valuation and concentration. And this one is probably the one that's going to hit our portfolios the most. But if you look at concentration in the top 10 market caps inside the S&P 500, 40% of the S&P 500 is in the top 10 names. And if you look at the valuation, how expensive are the top 10 names? Well, the average is you would pay around 20, 21 times earnings. And we are currently paying 28 times earnings, which means that we are paying 40% over the average valuation. This is a dangerous scenario. It's a dangerous scenario when so much market cap is concentrated into so few names, and it's a dangerous scenario when those few names are so expensive relative to their history. Now, this has been true for a very long time. I will tell you this is a landmine for 2026, and you probably say, well, yeah, I've heard that before. I heard that the year prior and the year prior and the year prior. But what I think is happening, especially since we're trend followers, if you look at what's happening in the Mag 7 complex, those magnificent 7 companies, we're starting to see some breakdown, we're starting to see some weakness, we're starting to see some consolidation. So this isn't actionable just yet, but if this landmine were to become actionable later in the year, if the Magnificent 7 were to enter a drawdown, I wouldn't be surprised. And if we can avoid that, and if we can mitigate that by avoiding the landmine, I think that would be a reasonable thing to do in a portfolio rebalance. So what does it all mean, avoiding landmines? Well, as of 2026, as our 2026 rebalancing approaches, I believe an avoiding landmine strategy will be prudent. The first landmine to avoid is getting posterized by midterms. And getting posterized, that's a sports reference there. It's the, I think it started with Michael Jordan and Dikembe Mutombo, you know, like the classic poster of Jordan dunking over Mutombo. And we're just trying to avoid that. We don't want our companies mentioned by Donald Trump in this election cycle at all. And if he mentions them, we want to be careful because I don't want to end up on that poster getting dunked on by Donald Trump. Second landmine to avoid is the technological disruption caused by AI. I'm not smart enough to know how much AI is going to disrupt the landscape, but I do have a tremendous amount of humility and respect for where the market moves, so the market will tell me. Third landmine to avoid is overvaluation and concentration. This one isn't actionable yet, but I want to be open-minded to the Mag 7 losing some of their luster. These ideas highlight a strategy that is about getting on base versus swinging for the fences. What I mean by this is we've had 3 years where the market has been rock star. Just about every client conversation I have is about taking risk up, swinging for the fences, more and more long shots that are more and more dubious. But if you were to ask me, what am I doing for 2026? I'm doing the exact opposite. I'm playing tight. I want to get on base. I want to hit singles. I don't want grand slams. And I think if we do that, we can get through this midterm year and preserve the gains that we've generated in the last 3 years. So there you go, avoiding landmines. How do you make money? One way of making money is by not losing it, and that's what we're going to try and do this year. I'll see you next week for the news review. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.